We're starting to see this, and I bet you're feeling this yourself. Credit card debt is at an all-time high. There's been so many media outlets that have been talking about this lately, saying that Americans across the country, you are not paying off your credit cards any faster. Inflation's up, money is tight right now, but a lot of you are starting to tap into your home equity into your house. So I wanted to do this video to give you 3 ways that you can tap into your home equity, consolidate some of that credit card debt, and start to get yourself back onto a good financial plan going forward. And if this is the first time you're watching my video, my name's Seanu Uyehara. I'm an area manager with Geneva Financial, helping you finance your homes all across the country. Whether you're buying or refinancing, my team can give you a second opinion on your financing to make sure that the strategy that you're using is the right strategy with your home financing. You can always send us an email to connect with us, and I'd be happy to chat with you offline. But in this video, I'm seeing more and more people reach out about consolidating credit card debt. That's not a good thing. I know things are tough right now, but the thing you have to remember first and foremost before you either do a refinance or any of these other strategies that I'm going to talk about today, you have to understand that you can't use your house like a piggy bank. And what I mean by that is I see a lot of people out there that will refinance or do a home equity line of credit. They're going to pay off some debt right now, and then in a few years later, they're reaching back out to us to do another refinance because they've racked up their credit card debt again. This is what I mean by not using your house as a piggy bank, because the more times that you do that, you are stripping away the equity that you've been building up into your house to the point where in the future, you could almost erode all of the equity that you've built up in your property. And if you ever got in a pinch, selling it is actually going to cost you money, because remember, when you sell your house, you have to pay commissions to the buyer's agent, the listing agent, and sometimes the buyer wants you to pay their closing costs. So you could easily be out tens of thousands of dollars to sell your home or try to short sell it, like we saw a lot of people doing during the crash in 2011 and 12, where home prices were just at the bottom. So now my warning is out there to you. Don't use your house like a piggy bank. But if you're smart about your decisions, here's 3 things that you can take a look at. Number 1, being a refinance. This is pretty common. A lot of folks are looking at cash out refinances because of the stability of the loan, but a lot of you hate this idea because you have 2 or 3 or 4% interest rates. And when you see a lender quoting you 7%, you think that they're high as a kite and they're ripping you off. Well, guess what? That's where rates are today. Now, if you're looking at a cash out refinance, the one thing that I don't necessarily like about that is that once you close on the transaction, you get your money at closing, but then you now have to start making payments on whatever your new loan balance is, and you're starting to clock all over on your loan. Now, why that's bad is because once you spend the money, you can no longer get any equity back or do anything else with the funds, which a HELOC is really good for, which we'll talk about next. So if you're going to use a cash out refinance, you have to be very diligent about where you're putting your funds. Don't just take cash out of your house because you want to fix your kitchen up, or you're just spending money to spend money. Let's say, for example, you owe $100,000 on your house and your value today is $300,000. So the difference between the value and your loan balance is your equity. So in this case, we've got $200,000 of equity that you can potentially tap into. But remember, lenders are not going to give you 100% loan to value of what your property is worth to give you the full $200K. It's not going to happen. Most banks will typically go to 80, maybe 90% loan to value in order to do a cash out refinance. So what does that look like? Again, let's take the $300K and let's just say an 80% LTV. So $300,000 times 80% gives us $240,000. That would be 80%. And then you're going to subtract your loan balance. If you don't owe anything on the house, then that's your complete equity that you can tap into. But for our case, we still owe $100,000 on the house. So you could tap into $140K worth of equity in the property. So once you get that money, your loan balance has now increased to $240,000, and that's what you need to start making payments on. So this is why on a cash out refinance, a lot of clients have stayed away from that, because you're increasing the balance and you're making payments day one on your mortgage. Sometimes you don't know what you want to do with the money. You just want to have it as a safety net, or maybe you're looking to buy an investment property and you just haven't found anything yet. So that's where there's some disadvantages to the cash out refinance. However, because of the stability it provides, sides, it does work out for a lot of you out there. Second option, you can look at a HELOC or a HE loan. Now, I wasn't too familiar with a HE loan until I actually went into my credit union and they actually offered a HE loan. So essentially, a HE loan is a second mortgage on your property. And unlike a HELOC, where it's typically a variable interest rate, you can draw on it and use the money as many times as you'd like up until your draw period is up. A HE loan, you have one fixed payment. Again, they give you a flat amount at the end of the day. Let's say in our case, they gave you $100,000 and now you start making payments back on the $100,000. They're predictable payments. You don't have to worry about interest rates varying and all that stuff. And I know so many of you get skittish of that. I don't necessarily think that's a bad thing because there's always a cap to what the rate is. And once the Fed starts figuring out what they're going to do next, they're going to start cutting rates eventually. And all those interest rates are going to start coming back down to your advantage. But a HELOC is pretty popular because of the flexibility of the loan. So a HELOC, remember, it's a second mortgage to your first mortgage. So in our case, let's just say we took out a $100,000 HELOC. You now have a payment on your first mortgage and now you have a payment on your HELOC. But you only have a payment if you draw on your home equity line of credit. So if you sat on it for a month or two, didn't use it, spend any money, you have no payment. However, one thing to pay attention to is that some lenders that are offering HELOCs require a draw up front. So what that means is when you close on your HELOC, you have to draw money on the HELOC. Sometimes it's $50,000. Sometimes it could be more than that. So make sure that you are asking that question, is there a required draw up front? That way you know the minute you close on it, do you have to take money out? Because the minute you take money out, you have to start making payments. But one of the advantages to the HELOC is that you can use it multiple times. So in our case, again, let's use that $100,000. If you had $100,000, you used it, you bought a property, let's say you flipped it, you made some cash, you paid the entire home equity line of credit off, now you have no payment again. You can use the money again over and over and over. And most HELOCs will have a draw period of typically about 10 years. So that basically means is you can use the money as freely as you want within that draw period. Once the draw period's up, you can no longer access the capital. Now you have to start making payments based on whatever is left on that line of credit. But here's the one thing you have to think about, and I don't think too many of you are thinking this far in advance. Remember, when you use your HELOC, you are creating debt against your house. You're tapping into your home equity. So if you're spending the money frivolously or you're gambling on an investment that doesn't pay off, you will have to make that payment back to the bank. That sounds pretty obvious, but here's the problem. A lot of you are not thinking that far in advance, and what's going to happen is down the road, when interest rates come back down, you're going to look to consolidate those mortgages into one mortgage again, which means you're paying money to do a refinance. So this is why you have to be very smart about your refinance or HELOC options that you're looking at today. Don't just rush out there to do a deal because you hear that interest rates are down, or hey, I want to get a HELOC, or whatever is driving you to do that. I literally spoke to a gentleman the other day. He refinanced with another lender probably 4 or 5 months ago, and now he called me and wants to refinance again. My first question to him was like, why do you want to refi again? Why did the other guy not do their job right? So these are the types of things where you want to make sure you're doing it right, because there are loan officers out there that are struggling for business today. And if you call them to do a refinance, they will do the refi. They're not going to ask you questions to say, well, why do you need the money, or why are you doing a refi if you just did it? They'll take the fact that you reached out to them and they need a commission check, and they'll happily process your application so that way they can get paid. Be very careful of that. And if you're finding this video helpful so far, share this with a friend. Sharing the videos out there on YouTube helps the algorithm, helps me spread the love and knowledge and education that I love sharing with you to help you make sure you get your mortgage right. And also, you can subscribe to the channel because we try to put out content every single week so that way you continue to stay at the top of your game when it comes to mortgages. Now, the third thing I want to share with you is a new program that we just rolled out here at Geneva Financial, and it's called our Home Select program. So it's a first lien HELOC that you are now paying your principal first compared to a traditional mortgage where you're paying interest first, and you can tap into your home equity for 30 years. Yes, 30 years. Unlike a HELOC, you can only tap into it for 10. With this loan, you can tap into it for 30 years. So a lot of our clients are utilizing this program today because, one, it's going to help them tap into their home equity, consolidate some debt, but free up more cash flow for themselves so they can start paying more money back towards their mortgage. And whenever they need to pay bills, they can use the home equity to pay off whatever credit card debt or monthly allowances and expenses that they incur. But the really, really good thing about this loan is that that you have access to your home equity. So you're eliminating another transaction down the road that you're looking about, another refinance or another HELOC. This loan is an all-in-one loan that you never need to touch ever again. It's something new that not a lot of banks want to offer or even talk about, because this program allows you to accelerate your mortgage debt payoff, so you're paying your house off faster. Remember, the banks want you in debt. They want you to have a mortgage, because the longer it takes you to pay that house off, the more interest that they can collect from you. Prime example of this is I want you to go Google an amortization schedule for any mortgage that you want. $300,000, $400,000. Look at how much interest you pay back if you were to stay in that house for 30 years. That's how much money the bank is making from you by sitting in that mortgage. So when you look at strategies like this program, like I'm mentioning to you, we can accelerate the debt payoff, get you to be debt free, and also give you more cash and capital to go and acquire more income producing assets. These are so many things that a lot of you want to do. You want to build wealth, you want to create passive income, and you want to be debt free and not owe any money to anybody. This is the one vehicle that's going to get you there. So if you're interested and want to learn more about the Home Select program, make sure to send me an email. I can go really in depth with your expenses, and I can customize this so you can see how fast we can pay your house off. But not only that, what can you then do with the extra money that you would be saving? Because this can be tens, if not hundreds of thousands of dollars that we can put back into your pocket to help you and your family with their financial future. Thanks for watching, and I'll see you on the next one.